Okay, hey everyone, welcome to September. Just quick sound check, and if everything's good, then we can get started. Hey everyone. Okay, sound seems to be great on my side. If there's any issues, do let us know and we'll fix it. Before we get started, just a quick general advice and risk warning disclaimer. Note that any advice given is deemed to be of general nature, as the information or advice given does not take into account your particular objectives, financial situations, or needs. Therefore, at all times, you should consider the appropriateness of the advice before you act further. Also to note here, we don't offer any investment services or automated trading, or paid signal service, or paid education and stuff like that. So we don't do that, just to add it in there. CFDs and Forex are leveraged products, thus carry a high level of risk and are not suitable for everyone. You can lose more than your initial deposit. So you should ensure CFD and Forex trading meets your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. Okay. Right, so we are going to talk about market conditions, mainly, obviously we're going to talk about trends, right? So we do have three different market conditions in the market. We have an uptrend, obviously we have a consolidation period, a sideways market condition, a range bound market condition. They're all the same, that's the in-between, and then we have a downtrend. The thing that a lot of people argue about, it's basically how do you actually identify which market condition they are in, what factors comes into play and stuff like that. So we are not going to be doing a slide presentation tonight. We are actually going to be doing more on the practical side. So we're going to take a look at the charts and then how do we identify them. Okay, so first up, let me just zoom it bigger. So we have an uptrend. Okay, that's market going up. Okay, and it's easily identified by market creating a higher high. Okay, so we are going to call that HH. Okay, and then we have the downtrend. That's your market going down and market creating a lower low. So that's your LL. All right, so these are your basic foundations. So first week we talk about momentum, we talk about volatility, we talk about the alphas, we talk about the betas. Last week we talked about some of the basic rules in drawing a trend line. So we are actually going to apply all of those into the market today. So this is very simple. You guys might get a bonus as well in 27 minutes. We're going to have the NFP numbers come out. So, you know, maybe I'll open up about 5 to 10 minutes talking about the market condition. But other than that, I'm not taking on any requests. Okay, on market outlooks tonight. There's going to be an educational session. You guys know it by now. Every Friday is going to be an educational session. All right, so we have an uptrend, market going up, market creating a higher high. So let's talk about that. This is what you're going to be looking at. We have a market that goes up, and then we have a market that pulls back or correct itself a little bit, but it doesn't create a lower low. So it'll basically complete its cycle within a set amount of retracement, which we're going to talk about later on in our Fibonacci sessions. But for now, let's assume that the market doesn't exceed the starting point. Okay, it pauses there for a bit and then it continues to rally up. So if you see a condition like that, you are going to identify that as an uptrend, partly because you can actually draw a support trend line. If you can draw a support trend line, then you are going to have an uptrend. Okay, so I'll make this part very easy. I'll make this part very quick because a lot of you already know about it. But if you are new and you need some clarification on how to identify those, that's basically that. Those are the two criteria. We have market creating a higher low and a higher high. So let me just HH and higher low. Okay. And then lower high, LH. Okay. So yeah, if you see a market creating a higher high, okay, that part is the higher high, and then it creates a higher low, then you know that it's in an uptrend. Very simple. That's basically the two criteria that we are looking for to identify a market to be in an uptrend. Okay, so if you have a market that does the opposite, market goes down, it pulls back, but it didn't create a new high. Instead, it starts creating a lower high, and then it starts creating a lower low. Then this is what we are going to classify as a classic downtrend. So what happens in between? You might not see this all the time, right? For example, let's take a look at the higher high here. Let's say the market continues to maintain a support trend line, but then all of a sudden it starts doing this. Okay, never got out of the range. Okay, so it will never go out of that range. It does that, and then it does this. Maybe I need to correct this a little bit, lower this a little bit. There we go. So this part here, it's what we call a market consolidation or a range-bound market condition. So typically in a range-bound market condition, the outcome could be that the trend could continue to go up, or it might form patterns like this one here, and it starts becoming a downtrend. We are going to see a reversal in the market. Okay, so that's that. Very simple. All right. The other thing I want to talk about is, let's go on to the chart, right? Maybe I'll find one that's kind of empty, like the pound USD, for example. All right, let's take a look at the pound USD. If I zoom out on the daily, how do you identify this market, right? Are you going to classify this as a downtrend or is it an uptrend? By taking a look at this without anything else. So I'm going to hide everything. I'm going to delete everything so you guys don't have anything. We only have the charts here. Okay, so let's take a look at this condition in the market. what's your view on the pound USD, for example? Now we're taking a look at this live, obviously. So this is the current situation. I don't know how can I get my money. I don't know what you mean by that. That's what we're here for, right? Okay, so if you guys can answer me this with with the information that I just gave you on what is an uptrend, what's a downtrend, what do you categorize the pound USD in the year 2022? Very simple, all right? So I need you guys to be more interactive with me here. So if you guys are watching this, if you guys can answer me, tell me what the pound USD is. Is it in a downtrend? Is it an uptrend? Or is it in a sideways market condition? While I'm doing that, a big downtrend. So we already have an answer. It's a big downtrend. The problem is if I switch into a smaller time frame, it might look different. So if I go into the 50-minute time frame, it's a completely different scenario, right? So what I'm trying to say is this. It's a downtrend, great. Downtrend, yep. So we know that on the daily, it's clearly a downtrend. It's very simple. It's very simple to identify. We don't have any indicators on the chart, and we need to identify what the current condition is in the market as quickly as possible. Okay, that's the number one, probably the most important part when it comes to charting, when it comes to technical analysis. You need to know what is the current situation in the market. Okay, so it is a downtrend. Consolidated, it's not a consolidation, it's a downtrend. Now, I might look choppy, right? It might, you know, to a lot of you, this is really choppy. It's really hard to identify. How do we identify this as a downtrend? It's pretty simple. We need to look at the swings in the market. Obviously, I'm going to draw it now. So we have that, and then we have this, we have that, there. Yeah, this might be considered. I'll consider that. But what we can see is that the market continues to create a lower low, and that's what identifies this as a downtrend. If you take a look at the market, this is at a glance, right? You know, some of you probably say, yeah, you know what, it's easy because the market is moved and stuff like that. But we use this to kind of identify where the market is and basically assume where the market is likely going to go. So if you take a look at the whole 2022, it's been a downtrend, but we do take long positions sometimes, right? We don't continuously go short on the pound USD. That's because in a small time frame, it might look different. Okay, so right now we know this is a downtrend on the daily, but if I go into the 50-minute time frame, you'll start noticing the market does something, right? If I zoom in on just this, you'll actually see the market doing this. All right, it actually starts creating a higher high. We didn't create a lower low. It continues to create a higher high. So the perception is this: a trend, it's going to depend on whatever time frame you're looking at. Make sense? So if someone tells you that the market is in a downtrend, I'll tell you that the market was in a downtrend. I don't need to tell you that. Everyone saw what happened just now on the daily time frame. But if you're using the 50-minute time frame, if you're using on the if you're trading on the hourly time frame, you are going to have a different perception on trend. So the number one thing for a lot of you guys, a lot of the beginners out there, if you are trading with reference to another trader, for example, a trading signal, or maybe you're looking at, you're watching CNBC, you're watching Bloomberg, or maybe you're reading articles on the website, and they say, oh yeah, the market was in an uptrend today, blah, blah, blah. It's all going to be dependent on the time frame that the analyst take a look at. Okay, so it's going to be really hard to identify a trend, because in every time frame there's going to be a different situation. Okay, let's jump back into the daily time frame. If I take a look at the whole thing that I created on the 15-minute time frame, it doesn't reflect anything. It basically reflects just yesterday and today. Doesn't really compares to the bigger outlook in the market. But basically this, if you see a little bit of a pullback in the market, for example, if we have a move to the downside and we have this pullback to the upside, which is technically a correction, and then we have this, the area where it creates an impulse or a move up, it's going to be in an uptrend within a small time frame. Okay, so this one is going to be in a downtrend on the hourly time frame. This one's going to be in an uptrend on the hourly time frame. So downtrend on smaller TF, right? That's the move down. Okay, and then we are going to have uptrend on a smaller TF for this one. Make sense? So, you know, when we talk about trends, you need to be really careful. When we talk about market conditions, we need to be really careful, because every time frame is going to potentially identify a different scenario for you guys. So don't just buy into someone saying, hey, the pound USD is in an uptrend, go buy pound USD. You know, they might be looking at a 5-minute time frame, they might be looking at a 15-minute time frame, they might be scalping the market. Maybe that doesn't suit your risk profile, it doesn't suit how you trade normally. So you need to be aware before taking on any information from any other traders out there or analysts out there, because everyone is going to have a different perception on trends. Okay, so that's probably the most misunderstood thing when it comes to trend. It's going to be time specific, it's going to be trends time frame specific. Every time frame is going to show you a different thing. Okay, so what about the hourly time frame? Let's take a look at this one. So can we identify a few things on the hourly time frame? Do we see anything here? Right? Do you notice that there's a pause in between before the trend continues? Right? So we are gonna identify this as a downtrend. Yeah. Very simple, but notice this part here where it actually starts to go a little bit flat. And if I draw the the rule about the higher low, higher high, and whatever not, I'll change the color in a minute, but you'll start noticing that it actually does something different here. It actually starts going down, creating a downtrend, and it creates an uptrend, and then it creates another downtrend, and then it creates it breaks out, and then it breaks down. Okay, so I'm gonna change the color here. We are gonna highlight that as orange, right? So the orange part there, that's what we call more of a market consolidation. It's more of a range bound market condition. If I zoom in, you can actually identify the limit in the market by taking this high and taking this low to create that sideways market condition, that range bound market condition. You know why? Because if I take this slightly lower, notice that there's no close beyond that high. So market does pierce through the resistance, but it never actually close above it. Okay, so it doesn't close above it, so that resistance is intact. If you take a look at where that resistance is, actually close to 1.19. All right, so this area here where I'm gonna highlight, that's your range bound market condition or sideways market condition or a consolidation, whatever you want to call it, right? You want to call it consolidation. It'll come in different forms, right? and everyone calls it different thing. But to me, they're all the same. That's a market that's consolidating. That's a market that's trapped in a range-bound market condition. That's a market that's trapped in a sideways market condition. This is where you get your headaches, right? If the market is as simple as an uptrend and a downtrend, that's done. It's easy. It's very clear. You're never gonna get it wrong, okay? Because if you take away that range-bound market condition, you have a very simple, specific rules to a trend. But when it comes to consolidation, range-bound market, or sideways market condition, that's where it's gonna get tricky. That's where your psychology is gonna get tested. That's where your mentality is going to get tested. Okay, and this is where your risk management comes into play. Okay, because if I assume that the market is in a downtrend, stuck in a sideways market condition, if you were to go short, let's say you have a short position somewhere there, right? Where's your stop loss going to be? A lot of people are going to place their stop loss here because that's the last swing high. But if you do place your stop loss there, you are going to get your stop loss, it's going to get hit eventually, right? The right thing to do is actually to place it all the way up there. It's just too big for a lot of people. That's 265 pips. Does it make sense? Obviously not. So depending on the time frame, again, you are going to see different rules, different risk management that comes into play. So I think when it comes to understanding a trend, a downtrend, an uptrend, or sideways market condition, when we talk about market conditions, I think the number one thing is what is your preferred time frame. Okay, if you look at one specific time frame, stick to it. I think 3 weeks ago, someone actually asked on the chat. No, actually, someone posted on the comments on in YouTube in one of our sessions. The question was, if I took an entry on the hourly time frame, can I then use the 1 minute time frame to get off my trade? The answer to that is going to be, it depends on your trading strategy. It depends on what you have planned ahead. Okay, so it's not going to be a simple 1 + 1 gets you 2. It's more like a quadratic equation when it comes to a sideways market condition. Because if we talk about sideways market condition, it could be flat. So let's go back here. We've got 9 minutes, and then I'll cover the NFP for you guys, so don't worry about it. I know some of you jump in here for the NFP. Okay, so let's say we have a market condition that's contained within range like that. Oh, that's actually going to be easy, right? The reality is we kind of expect that as a potential resistance, that as a potential support, and the market goes on and on until there's a potential breakout. This is simple. This is a very simple range-bound market condition. But what if we saw this? We talked about chart patterns here last week. We talk about triangles. We talk about flags. What if the market consolidates in a flag? You know, the market does the consolidation like that. It'll fulfill this. It'll actually fulfill the condition of creating a higher high, because the market is going to go like this. It'll create a higher low. It'll continue to create a higher high. It'll create a higher low. It'll create a higher high. Now, when it comes to identifying market condition, that's why I design it in a way that we take a look at momentum, we take a look at volatility, then I show you the chart patterns, and then now I want to talk about the market conditions, because last week's session has prepared you for the potential of identifying this sideways market condition or this consolidation. Now, what is the pattern that I just drew? If you guys can answer me here. And what does it actually identify? What does it tell you? What is likely going to happen, right? So again, it's going to be interactive. So we are going to do lecture tutorial. So this is your tutorial session. If you were here last week, you missed last week, it's okay. You can watch last week's session, but I know some of you guys are here from last week's session. Can someone tell me what is it that we're looking at? This form of consolidation in the market, what is it and what does it mean? What is the probability of where the market is going to go next? Identified as a breakout, downtrend. No, this is something. This is a pattern, right? There's a pattern. It's a bearish flag and expecting further downside. Correct. And there's a very good example on this that we have actually been looking at the past week. There's one on the pound USD. There's also one on the Euro USD, which is right now. Okay, so with this, it is a consolidation, right? We consider that as a consolidation because the market is correcting itself, it's retracing itself, and then the higher probability is that it's going to break to the downside. Okay, very simple, right? So if we take a look at this, we break it down into perspective, then we understand what is actually going on. Because if it does break below that support trend line, if it comes out of that formation, if it comes out of that pattern, then it becomes a downtrend continuation. Okay, so if we don't look at the chart, we just identify it like that, it's going to be super easy. But that's great, you guys answer it correctly, and that's awesome because that means you guys are paying attention. These are the thing, these patterns are the thing that we want to keep an eye out on, right? There's actually one that I want to show you guys on. It's actually on the dollar Japanese yen, I believe. Let me just get my dollar Japanese yen. We prepped it, okay? See this? We talked about this last Monday. We talked about this last Wednesday. We were waiting for, there's a pattern here. Do you guys see it? There's actually a pattern here. If you guys can tell me what that pattern is that we are looking at. Okay, we talked about this last week. There's actually a pattern here. So we are trading that breakout here. I think let's leave that for a minute there. But there's a pattern here. Do you guys see that pattern there? It's not a falling wedge. We have a flat line. We have a support trend line. What pattern is that? Okay. No takes. It's not a falling wedge. Definitely not a falling wedge. This is recent. We talked about this on Monday. It's not a flag. It's not a flag. This is an ascending triangle. It's an ascending triangle. TY has been paying attention because TY answered bearish flag first, and then he answered as ascending triangle. So an ascending triangle is a form of a consolidation, right? That's why we have the red line here, because we anticipate the potential outcome. Either the support trend line is going to support the dollar yen, or it will actually become more of a flat range bound condition. But there is a probability of it becoming an ascending triangle, and this was something that we take a look at on Wednesday. Okay, so those that jump in on Wednesday probably got this trade. So, sometimes it's just there. It's out there. As long as you know your patterns, you know your formations, you can identify that consolidation period to be more of, does it carry a heavier probability of being a continuation pattern? Does it carry a probability of being a reversal pattern? At this point, it is an ascending triangle. At a psychological price level at 139. Okay, it's not a rising wedge, guys. Okay, it's different. A rising wedge doesn't look like this. It is an ascending triangle. Rising wedge is a reversal pattern. This one is a continuation pattern. That's why we are aiming for more of a continuation on the dollar yen. You missed out on the Wednesday session. We did talk about this last Wednesday, about the ascending triangle. So, you know, this is where you start applying your patterns in market conditions to know what's going on. If I zoom out, you know, you can see that the market has been in an uptrend and then it forms an ascending triangle. So there's still buyers in the market just waiting to buy on dips. That's the whole idea. There is a close above the resistance at 139. That's where you jump in long, and that was basically the prediction that we kind of made on Wednesday. It's more of an outlook, right? So the market isn't as random as you guys think. There are patterns in there that you can actually use to kind of identify what kind of consolidation it is, right? It's not going to be like this all the time. It's not going to be like this all the time. You know, it could form that. You know, there's a lot, right? If market goes up, for example, all right, someone has been talking about wedges. Let's take a look at a market that goes up, okay, and then it starts doing this, right? So it's starting to lose momentum. So that's what we call a rising wedge. If I can draw this correctly, I might need to make some adjustments, but yeah. So if we draw this, then yeah, you know, you'll notice that the support trend line and the resistance trend line seems like it wants to meet up. That, my friend, it's not a continuation pattern. It is actually a sign of potential reversal in the market, because the next move the market, we got the NFP number, unemployment rate up 3.7% from 3.5%. NFP number is 315 versus 300K. So let's take a bit of a break and jump into the market and see what's going on here, because I'm curious myself. Okay. So higher unemployment numbers doesn't bode well for the US there, for the FOMC. The market was anticipating more of a stronger employment sector yesterday from the unemployment claims, but we have a jump in unemployment rate by 0.2%. So that's not boding well for the FOMC. So they might consider slowing down the pace of that rate. I don't know, but the market is definitely taking a look at that as a dollar weakness. If I go on to the US 30 and the S&P or gold, it should be pushing up. Yeah. Okay. So that's done. Okay. Let's leave that and let's get back to topic. Okay. So if we see a market like that, then there's a potential for the market to actually break and reverse. Okay, so we need to identify reversal patterns. We need to identify continuation patterns during a period of consolidation. Okay, so consolidation is not always going to be flat. It could move in a parallel channel. It could move in a triangle. It could move in a wedge formation. So that's the basic. Okay, I'm not gonna talk about the basic now. Next thing is, we take a look at this. It does look a little bit confusing, right? It's very hard to identify because if we're looking at candles, you know, you're gonna see the spikes here and there. It's very hard to filter out a lot of that information. There's actually different chartings that you can actually use. If you watch CNBC and Bloomberg, they're gonna use this. This is called a histogram. Okay. It's basically a line chart with shades underneath it, but it's the same thing as a line chart. Now, what is a line chart? In essence, if you want to know what a line chart is, it's actually a simple moving average, one simple moving average. So if I set the moving average to 1. Okay, that and the line chart, it's going to be, sorry, there must be a different setting here. Time frame chart, yep, length SMA 1. Okay, so one simple moving average, it's actually the same as a line chart. So you notice that if I put in a line chart, it's actually going to overlap. Well, a line chart is an average of price, so it's not there to be very specific, but it's there to give you a kind of a quick picture of where the market is heading, you know, what kind of market condition it is, right? If you see how choppy it is, where we have that consolidation period, you know that's not a downtrend because the market is really choppy. Okay, so it actually helps if you simplify things. If you go on to the 15-minute time frame, for example, let's take a look at the current condition right now. Oops, there we go. So with the current condition on the 15-minute time frame on the pound USD, what is it actually creating? It could potentially create a new uptrend in the short term, right? It's there to filter out the noise. Either you want to look at this or you want to look at this, you know, pick a choice. It's just a matter of preference. But if you're confused on what the market is telling you, always make it simple. You can always turn it into a line chart. You know, later on we're going to talk about Renko and Kagi. You can always change it into a Renko as well if you want to. See, if I change it into a Renko, it's a lot simpler, right? If you don't like moving averages, it's very choppy, you can always go with Heikinashi. Okay, it actually smooths it out a little bit. But point is, today, try to use line chart once in a while if you are confused. Okay, so we talked about trend lines last week. So I don't think we're going to talk about trend lines again tonight. I want to leave you with a couple of tools that you can actually use. We are actually going to be using moving averages, right, to identify trends by using moving averages. A lot of people have moving averages as a tool for you to buy and sell, to get in and to get out, but we can actually use moving averages to help you identify a trend. Okay, so I'll have two moving averages. So I'll get one and another one. So we have two moving averages. I like to use exponential moving averages, right? I like exponential, but pick a number that's actually very similar, like 100, for example. Okay, so if we have one line there, that's going to be 100. So I'm going to hide the second one first. Okay, how do we look at moving average as a trend indicator? If price is trading below the moving averages, then you can classify that as a trend. But when it gets choppy like this one here, it's going to destroy your trade as well, right? Consolidation, range bound market condition, or sideways market condition could have an impact on your trading. All right, if it's trending, it's smooth sailing, you can just say, hey, you know what, it drops below the moving average, I think we should consider it as a downtrend and trade it, right, until it stops being below the moving averages, which is over here. So you can take that as your cue to jump in short, okay, and then get out over there when it moves above the moving averages. That's 315 pips, not a bad trade on the hourly time frame. See, right? So just by adding one simple moving averages, the market will start to tell you whether the trend is going to be. You want to be more specific, you can actually add another moving averages, right? We had 100 just now. Maybe we'll have 80, right? I'm using exponential moving averages. I'm gonna change it to red, so this is 80, right? It doesn't tell you the downtrend until it's down here. So we're not looking at prices anymore. We're starting to look at crosses. All right, that's the start of the downtrend. You'll actually see the end of the downtrend right where it consolidates over here. Right, that's where you want to get out. Simple as that. Okay, just a few moments later, it starts breaking down below the range, and then the moving average starts to cross over again. Then that's where you want to go short. Okay, why do I keep getting the up arrow? I want down. There we go. Okay, so notice this. If I change the moving average to something closer to 100, let's say I want to have it at 95. I haven't changed this. There we go. Right? You'll notice that it's not going to give you a flip-flop in the market. In fact, it's actually going to flatline. It's actually going to stick together. And the where it crosses, it's actually going to be less often. You see this over here? During the consolidation period, it actually flattens out. It doesn't give you a reversal sign. It actually sticks to the moving averages. Okay, and for now, we take a look at where we are right now. It still widens out again. Then we're still in a downtrend. That's one way to filter things out. Obviously, you can use one single moving averages, but this moving averages needs to be very close to one another in terms of the periods, right? If I change this to not 95, if I change this to 25, for example, right, it's going to give me a different signal because it's not going to give me the trend. In fact, it's actually going to be really, really choppy. Okay, so when it comes to moving averages, we'll talk about this when we focus more on the different moving averages, but keep this in mind. Two moving averages close to each other is used to identify trends in the market. Okay, for example, 100 and 95. Maybe you want to use 50 and 40. Maybe you want to use 20 and 15. Something very close to one another in terms of period. They're actually used to identify trends in the market. Okay, so that's one tool. The other tool that I normally use, it's actually I'll lift this for a minute so you guys can take a picture. Maybe if you guys want to take a picture of it. Is it better to use exponential moving average or simple moving average? Please explain the difference on both. Okay, I'll explain EMA and SMA in a simple way. Exponential moving average reacts to price a lot faster than simple moving average, right? Simple moving average is just a simple moving average. It's really the average of price. Exponential moving average tracks price a lot faster than simple moving average. And then we have the weighted moving average. I don't think a lot of people actually use weighted moving average. In my whole trading career for 20 years, I have actually never used WMA, but it's there as an option. Between EMA or SMA, I prefer EMA. To me, EMA it just reacts to price a lot better. So I can give you an illustration between EMAs, right? So I'll add another two moving averages, right? So I got two more moving averages, and I will make one 100 SMA, and I'm gonna make the lines super thick so you guys can see the difference. All right, I'll make it pink. So this is the SMA, right? SMA. The second one, we are gonna go with EMA, and you'll actually start seeing the difference. Okay, Notice that they move about the same, but one versus the other. Let me just change that. This is SMA. I shouldn't make it thick, yeah, because it kind of overlaps. There we go. Is it this one? No, I'm sorry. That's this one here. Right. It's going to be tough to look at, but they are not the same. They do have a difference to it. It's just not showing on this trading view for some reason. EMA and SMA are not the same. I'm just not able to get this to show. I'm so embarrassed right now, but EMA and SMA are going to be different. But yeah, the difference is minute, right? It really depends on the tools that you want to look at. But if you take a look at the line here, it's kind of overlapping, but they're not the same. Okay, so there's actually two different methodology in terms of calculation. They are very similar, but they're not exactly the same. So, you know, I prefer EMAs. Some people use SMA. I tried zooming. It doesn't work here, but it'll show you a different thing on the MT4. I just never use moving averages on the trading view a lot. You know why? Because I've got other tools than moving averages. A lot of you guys know what that tool is, and that tool is the Ichimoku cloud. So I'm actually going to add it here. We are going to talk about this later on, but let me give you a little bit of a brief explanation of the Ichimoku cloud. We are going to hide the baseline, we're going to hide the conversion line, we're going to hide the lagging span, which is the Chico. We are going to use this, and as simple as that. Okay, so the logic is simple. If the market, you'll start noticing this, the market goes in a downtrend there, right? The moment it transitions below the cloud, it becomes a downtrend. Notice the pullback here, right? The moving averages attempted to cross over, but didn't cross over, right? But I see that region there where it's actually inside the Ichimoku cloud. To me, I don't trade during that period where it's inside the Ichimoku cloud. That's where we consider that as a consolidation period. The longer it stays in there, or if the line gets choppy or whatever, like this, then that's where we consider that to be more of a consolidation period. Now I can actually classify this as a consolidation period by drawing a range in there. It is actually forming something. Can someone identify what is it that is actually being formed here? So see, tonight it's practical. Something is there. There's a pattern in there, right? If somebody can actually give me that pattern on that blue box there, just a quick test. It's something very similar to what we just discussed very, very recently, but it's actually in reverse. So waiting for answers. Do you guys notice something? Something is there. No? No take? Okay. I'll draw it for you. I'll hide the Ichimoku cloud for a minute here. I'll move this out of the way. Double bottom? No. Yay! TY again, right? There's actually a descending triangle that goes all the way back up here. Okay, there's a descending triangle. Okay, so we use all this in combination. Thank you. The three answers there, descending triangle. So all these patterns comes into play when the market consolidates. Now I use Ichimoku because when I look at market going inside the Ichimoku cloud, that's where I see the potential for the market being consolidated. Ichimoku is a little bit unique because you guys probably wondering, hey, I'm looking at a little bit of a choppy regions in the future over here. It's really choppy. How do you actually tell it's going to be choppy, right? Because Ichimoku cloud actually projects 26 periods ahead. This cloud where market get rejected and stuff like that is actually formed before it happens. It's actually the current price shifted 26 periods ahead. So this is what it is. This is right now, price is here, Ichimoku is already drawn there. So if the market goes up, I can figure out where the potential rejections are, or if the market goes inside the Ichimoku cloud, I consider that a consolidation period. There's something unique about this, might be a little bit of a trivia, right? The Westerners call it Ichimoku cloud, but in Japanese, in Japan, it's called a kumo, right? A cloud is a kumo. Kumo is actually also a spider. So I always consider the Ichimoku cloud to not be a cloud. It's actually more of a spider web. It's like price gets inside the Ichimoku cloud, it could get stuck in there. But that's the whole idea behind it. But if you take a look at the Ichimoku cloud, it's actually really simple. If it's below the Ichimoku cloud, then we consider the market to be in a downtrend. So yeah, below cloud equals downtrend. Above cloud equals uptrend. Within cloud equals correction or sideways or consolidation, right? So if you use Ichimoku Kinko Hyo correctly, you break it down in the simplest form. It's actually a very useful tool. It's a very quick way to look at things. Ichimoku Kinko Hyo actually means one look equilibrium chart. So basically, just by looking at it very quickly, I can actually identify where the market is, and that's useful to me as an analyst, as a trader. I manage a lot of different assets, so I need to take a look at a lot of charts as quickly as I can. All right. Every morning I have to create a report. I have to create an outlook. I have to pick which ones to look out for today. So yeah. So let's say we'll take a look at the Euro USD with the Ichimoku cloud right now. Then you'll start noticing something. The Ichimoku cloud is actually very, very thin. So there's actually a potential for this one to transition easily outside above the Ichimoku cloud. Okay. We know it's choppy. We know the Euro USD is choppy because price is actually just bouncing in and out of the Ichimoku cloud. Okay. But with this one, if it does break above the Ichimoku cloud by transitioning outside of it, then the probability of it finding a lot of support is actually going to be stronger because there's actually going to be support up to about 99.75. Within the Ichimoku cloud, it could bounce back, it could stay there, and then do that, right? That's how we look at Ichimoku Kinko here very, very quickly. But let's go back to pound. Well, probably not pound USD. Let's go on to something else with something that I don't normally take a look at. Maybe there's no drawings on the chart. All right, take a look at the dollar Swiss, for example. Okay, so this consolidation period, you'll start noticing it bounces in and out of the Ichimoku cloud and stuff like that. But this is not the whole Ichimoku Kinko Hyo. We are going to talk about Ichimoku Kinko Hyo. Tonight is actually more of an introduction to you to start using Ichimoku Kinko Hyo. This is the complete Ichimoku Kinko Hyo. It's actually very confusing, right? It's one indicator with a lot of lines in it. If you take a look at this and you're a beginner, you are going to get messed up, because if you take a look at this and you're going to start reading all this, what's going on here? What am I supposed to look at? Because there's like 5 lines in there. Okay, so we are, if you want to try it out, hide the conversion line, hide the baseline, hide the lagging span. We need the leading A and the leading B, or the Senko A and the Senko B, to actually form the Ichimoku cloud itself. But hey, this is called Ichimoku cloud. You can actually get rid of it, but Senko A and B is actually what forms the Ichimoku cloud. So if we simply we simplify it, knock it down really simple, you can break it down like that. It's you can actually take a look at the dollar Swiss right now. Why we worry about the dollar getting stronger? Because it broke above the Ichimoku cloud. You know why? You know why it could be a problem? This is the dollar Swiss, right? We might be looking at this high as a potential. That's about 1.0050, right? It actually goes all the way back, but the key level is actually at 1.0050. Yeah, 1.0050, right? Obviously, we are going to be looking at that potential. The market could go back to 1.0050, or it might actually go back to parity again. So yesterday I said we don't have a lot of currencies at parity. Dollar Swiss is actually one example. We could be heading towards parity again, right? So, market could pull back to 1. That's basically the concern. If we take a look at the patterns, there's actually something else in here. There's actually a butterfly. But if we take a look at the fib on the weekly, it's actually going to form this. Take a look at where the 127.2 is. It's actually between 1 and 1.0050. We are going to talk about Fibonacci in the future, but this is something that we, why I'm actually more concerned about the potential for the dollar to get stronger, because it's actually starting to transition above the Ichimoku cloud. It was within the Ichimoku cloud last week, and then it starts going above it. So we are above the Ichimoku cloud. So that's on the daily time frame. What about the trend on the hourly time frame? Does it hold any significance? Yes, the hourly time frame is also above the Ichimoku cloud. Okay, so what about if I'm trading on the 15 minutes? Can I use it? Yes, you can also use that on the 15 minutes time frame. We are above the Ichimoku cloud. We are looking at support around 98, because that's where the Ichimoku cloud is going to be. So if we see Ichimoku cloud, we think support and resistance immediately, right? So if we take a look at 98 as a potential support. Is there any significance to 98? Of course, there's going to be significance at 98. I'm just going to draw it here, right? 0.98. Okay, that's basically where the resistance becomes support, and that's where market just find buyers and sellers. So if the market comes back down, how far is it going to go? On a 15-minute time frame, I'm probably going to be looking at 98. So is it the same scenario in the 5-minute time frame? Let's take a look at the 5-minute time frame. All right, it's showing you different things. 1 second, that's a tick. No, I don't think I have 1 minute here. Do I have 1 minute here? So let's go into the 1-minute time frame. Still above the Ichimoku cloud, so everything is in line, right? This is great. If we have everything in line, we have everything above the Ichimoku cloud, then yeah, it's completely fine. It's completely great. Okay, that's how we know how strong a trend is if everything is in line. But it's not going to be the case with everything, because on the pound USD, for example, right? We take a look at the hourly time frame. It's still above below the Ichimoku cloud. If you take a look at the 5-minute time frame, it was above the Ichimoku cloud. It just transitioned below the Ichimoku cloud after that news release, right? 15-minute time frame, it just transitioned below the Ichimoku cloud as well. Okay, so different time frames are going to show you different trends. I need you to memorize that. I need you to keep that in mind, because if you listen to me saying that, hey, the pound USD is in a downtrend, maybe you have other speakers looking at a different time frame and they have a different view of it. Is it wrong? It's not going to be wrong, because I respect everyone that trades on a different time frame. So I respect the thought that everyone will view the market in a different way. Okay, that's why I say every trader is going to be unique. They're gonna have their own perception of the market, so it's completely fine. Just make sure when you read about an article that says, you know, something is in a downtrend, be specific with it, right? They are gonna say, oh, the daily chart shows this, the hourly chart shows this. That needs to be taken into consideration, because the smaller the time frame, the shorter the trend is going to be. It's not going to give you the whole big picture. If you are going to be trading within the week, right? That's why we have that market outlook every Monday. You know, I talk about, you know, prices still below the Ichimoku cloud, prices within the Ichimoku cloud. That's to give you a guideline of the, you know, what are the probabilities. Because if we are trading below the Ichimoku cloud, if we're trading in a market that's in a downtrend, we are actually expecting corrections. We're not expecting new highs. This one is capped at 61.8. So some of you know this, some of you don't. You know, this is still within the norm of a normal correction. So if I zoom out a little bit, what do we see here? Do we have a pattern here? Do we actually have something in here, right? Is it 20 bars? Let me check. Yeah, it's past 20 bars. So maybe I'll talk about it right now, but we'll delve deeper into this later on. If we have a channel that's more than 20 bars, we don't consider this a flag anymore. We actually call it an ascending channel. It's just an extended flag. So with this one breaking to the downside, is there a probability that this one could go down? Yeah. What are the potential support for this one? Well, take a look at this low here. That's at 1.15, which is a psychological price level. So we are going to take a look at if the market does continue to go down tonight, how far can it go down? It might potentially go down to 1.15, right? If not, it might actually go back up here and get stuck within this channel to the upside and stay within the Ichimoku cloud. So that's scenario number one. Or the other scenario is that we just saw that break here. We could potentially go down here. So when it comes to looking at the market, when it comes to working out what are the conditions, normally we don't go with one idea. We always come up with two possible scenarios. I'm someone that always think of the worst case scenario. So I might be in for a short right now on the pound USD, right? But I have that backup scenario where, you know, yeah, it might pull back up a little bit. There's a little bit of a room for it to potentially go up to 1.16. Just in case, if I were to go short, the reason why I have two different scenarios is that I know where my stop loss is going to be. My stop loss is going to be above 1.16. That's beyond the Ichimoku cloud. That's beyond the psychological price level. Then I might want to go for 1.15. Simple as that. So if you start understanding the market conditions, you'll start having these different ideas, right? And then you weigh these two different ideas. What probability is going to be higher? Is if you were given this scenario like this, and I ask you this question: does the pound USD have a higher probability of creating a move to the upside, or does it have a higher probability of creating a move to the downside? Consider it. The market is in a downtrend, so there's a higher probability of it creating a downtrend, a continuation to the downside. So you need to consider that. And that's the reason why we look at different market conditions. We try to understand different market conditions, right? So you actually know the potential risks that you are doing when taking a trade. That's as simple as that. You know, identifying market condition is not for you to be boastful about. If you're good at it, then great. But it's not something that says, you know what, I say this is going to happen, and then tomorrow I'm going to say, you see what I did there yesterday? I was right. All right. It's not like that. Trading is not a competition, right? There's no point on being spot on. It's better to actually use that knowledge to minimize your risks. I think that's the key to successful trading. Okay. So let's open up for some Q&A. If there's any Q&A, we'll take that on. while I'll go through some of the questions there. No questions? Okay, that's great. So you guys got it, right? So I'm gonna throw in a test again next week. All right. So yeah. Again, with the educational session, it's not always going to be, lecture slides. So we will do something more practical as well. If the topic is right, we will do some practicals as well, like the next session. Okay. Yeah, I'll answer stuff about these. I haven't taken a look at the NFP numbers, but let's take a look at the NFP numbers. So we've got NFP numbers for the month of August. The gain was 315,000 from 300,000. The unemployment number was weak. It was 3.7 from 3.5%, right? The unemployment numbers, the lower it is, the better it is. Right now, the market gets a little bit choppy here. Part of it is that we have a lower hourly earning month on month. Year on year, we have a lower hourly earnings as well. The wages are lower. The NFP number, the previous number was that revised up? Let me see if the previous number was revised up. No, there's no revision. So yeah, unemployment rate was bad. The average hourly earnings was bad. The gain in the NFP was actually better than expected, by about 20,000. Not much, but I think the key data this week was actually the unemployment numbers, the unemployment claims yesterday. So let me go through the jobless claims yesterday. That was actually lower than expected. Sorry, it was lower than expected, so that was actually good. So the market right now in terms of NFP, if we take a look at the movement in the pound USD, this is really choppy. The overall tone is this: the NFP might be good. The unemployment rate was actually higher, which is actually not good, right? In the short term, there's a potential for the market to take a look at this as a potential. That there's actually two ways to look at this, right? I'll tell you my point of view in a minute, but most of the traders are probably going to look at this and say, oh yeah, bad economic data are actually good for us, for equity traders or for risk assets, because the thought is that if the data is starting to pile up, it's starting to look bad, then the FOMC might slow down the pace of interest rate hikes. Now, I'm going to give you my view. We talked about this last week and the week before that. Sorry, last week at the when the Jackson Hole thing, that was last Friday. I posted this on the Telegram group. My view remains the same, right? The FOMC is determined to continue hiking interest rate and warn of an unusually higher interest rate hike in the month of September. They're going to do that at the end of the month, right? The probability right now is at 75 basis points. To them, one CPI means nothing. Therefore, one employment numbers like this one is not going to impact what they're going to do. So the market right now is being torn. If you take a look at the movement here, if I go into the 15-minute time frame, it's actually going to get choppy. You see this, right? It goes up and then it goes down again. It might potentially actually goes up again, right? But the thought is this: there are some traders that assume the current increase in unemployment rate is going to stop the FOMC from hiking interest rate too high. The other side of the party is going to assume, like what I assume, is that the FOMC don't care about this month's data. They care about maybe 3 months or 4 months data compiled together. But if they can disregard the CPI numbers that was lower last month,
they are likely going to disregard the NFP numbers, because to them, what is a hike? What is a move above from 3.5 to 3.7%? It's still below 4%, and that 4%, if you remember from last year, that was the projected goal for the FOMC. You know, tightening labor market, they want to push it down below 4%, and they achieved that. So I think the jump up in unemployment rate to 3.7%, the impact might be minimal. In the short term, we could see market fluctuate. That's why I was assuming there's potential for this one to actually, it might push a little bit higher, but it's likely going to be limited in terms of range. You know, how high can it go up? Maybe about 40 pips, 50 pips. That's about it. You know, in terms of resistances, we do have potential resistance coming in at 1.16 on the pound USD. So this is one example. This is how the mindset is. So is there a short-term potential for the market to push higher today? Yes, there could be a potential. So, but if we take a look at the grand scale of things, because it's technically in a downtrend, I'm not taking that trend to go long. Even for an intraday trade, you guys know me, I do not go against the trend, and the trend that I looked on, it's always the daily or the hourly time frame. Very simple logic there. So I will actually wait for price to go up, get tested, unable to break resistance. You know, you could potentially get a short there, maybe a stop losses that's slightly better, and then you get a much better risk reward ratio, right? Rather than you going in, for example, going in short here, having a stop loss above 1.16, and then your target, it's the same at 1.15. What's your risk reward ratio? One, you're gonna risk double, or the other one, you're gonna risk your potential risk to reward ratio is actually 1 to 4, right? So you might be risking 21 for an 82 gain. I like that idea better than this one. So I always come up with different scenarios, especially right now. But if you want my view on the whole NFP and unemployment numbers, I give you my view on that one. Okay. 528K to 526K. You mean the revision? Yeah, the revision is not much. While using the Ichimoku, why you don't use the Tenkan and Kijun? I actually use the Tenkan and Kijun. So let me show you my chart. If I use the Ichimoku Cloud, I actually use Tenkan and Kijun. The reason why I hide Tenkan and Kijun is that to a lot of you guys, it's very distracting. Right, but if I use Ichimoku Kinko here, I do use Tenkan and Kijun. But I can substitute Tenkan and Kijun by using Fibs, for example, or using moving averages, or using momentum. That can be substituted, okay? But today is just an introduction to Ichimoku Kinko here. So don't rush into things, just slow down a little bit. Does GBP/USD and EUR/USD always follow each other in suit? No, they don't. It doesn't work that way. We'll talk about this in triangulation and correlation. So that's coming up as well. So we'll take this one step at a time. So don't worry about it. Okay. All right. I think that's the time that we have for tonight. I guess have a great weekend, everyone. Thanks for joining in, and I'll see you Monday for some of you in the Telegram group. Other than that, everyone else, I'll see you on the Market Outlook, or on Wednesday for the Live Market Outlook. And then next Friday, we are going to have an educational session again. Okay, so have a great weekend, everyone. Stay safe.